Happy birthday to you. Happy birthday to
Oh, you
you.
really?
Happy birthday, dear Corey.
Hmm.
Birthday to you.
I was wondering why you were so excited to start this episode.
And I haven't said shit to you all day about your
I
birthday or anything.
know.
I was super
Just
excited.
silently, I was hoping you forgot.
I
Well,
know.
thank
Well,
you.
that leads me to my first two questions. One are, as a man, does any birthday after 21 matter? And the second part of that is, the what I've found, I'm curious if you find this too, is like if I look at like other men my age, I'm like, wow, they're an adult, and I'm like, when does it start to turn where I feel like an adult? So sometimes, even though you're much younger than me, sometimes I think you're older than me because to me you seem more like an adult than I do.
Yeah, I think all of us men perpetually are stuck at age 18 in our heads. We just
Right.
think we're 18-year-olds all the time. And then it's fighting the reality of your body telling you, "Hey, you're not 18 anymore." That's,
Exactly.
the mind is writing checks that the body can't cash, or you know I'm as good once as I ever was, whatever that song is. So yeah, look, as to whether a man should ever celebrate a birthday after 21, look, you do whatever you like. If you like your birthday and you want to celebrate it, you do you. I'm not here to yuck on anyone's yums. Like, just have fun. Do I like celebrating my birthday? I mean, I like having cake, but do I need to make a big deal out of it? No. I just internally am a fatty who loves cake. So if I can take the opportunity to get a nice homemade cake from my mother on my birthday, I'm going to take it. But I don't need a celebration. My wife keeps asking me what we're doing for my birthday tomorrow, and I keep silently walking away,
Yeah.
hoping she'll
I
give up.
I absolutely hate birthdays. And then last year you tweeted it out. So I'm trying to like get you back in some way, shape, or form. But also
The
before we
revenge
get
birthday.
started, I want to remind everybody this show is hopefully for entertainment purposes only, and hopefully we manage to entertain. But this is definitely not investment advice. Please seek out your own investment advisor and do your own due diligence. So we always have to hit that at the top because once again we're still having technical difficulties and can't get our disclaimer to work. But I also want to point out we are twinsying it up today, so I have to
Yes.
address that. We have these beautiful pirate sweaters, courtesy of you. And
Listen,
man,
I
they're
felt
actually
like we
quite nice.
needed a uniform. That's how I felt. I felt like it was unprofessional for us to come to work not appropriately dressed. These felt like a great uniform. You found these. I had to send them out. Though that said, I do know you only have 3 shirts to your name, so I felt a little bad adding something to your collection. I won't be insulted if it somehow gets left behind in your travels.
I was actually trying to think about a good analogy for it, and maybe we'll get to this later. It's like the CPI basket number. When you posted that video with Cam Harvey, it's like one comes in, one's got to come out. So now I
That's
have to get
right.
rid of something. But what is it? Is it? I want to give them the shout out. Is it Seawell? Is that the
Yeah,
company?
Seawell. Yeah.
Seawell. These are actually super comfortable, and also just so you know, they're made from. This is great branding. They're made from recycled oysters and recycled bottles and lamb's wool, and they're actually like a great summer sweater. They're actually kind of
Yeah,
light
it's.
and
I
real.
will. I will tell you, my wife stole mine. Mine came in late last week, and she has stolen it and worn it all week, rather than me getting to wear it. So it's nice to actually have it for once. I do want to
That
get to
not
the inflation thing. I do want to say I did hear a great disclaimer this week. I was listening to another financial podcast, and it was a live event like this, and they said, "Look, if you plan on taking this as financial advice in any way." What you need to do is you need to look to the upper left of your screen and you see the big red X. We need you to click it. And I said, brilliant. That's all you need to say, right?
yeah.
So
Well,
anyway, moving
you
on.
would, except for yes, the regulators don't find it when we get cute about
Right.
disclaimers.
That's
they
right.
don't find
Yeah,
they don't
there's
find the
no
humor in that.
I think I told you in my quarterly commentaries I write for my fund. Look, I'm a big believer that people like to not interpret. People like to read different things. Some people love super in-depth commentaries. Some people just want the high-level stuff. So at the beginning of every section, I have a too long didn't read. That's a like tries to be a 1 or 2 sentence summary of every point I'm going to make. People can read that, and then if they want to dive in deeper to that section, they can. If they don't, great, move on. I'm not insulted. Like, people are busy. You don't have to read my commentaries. And after a quarter of doing that, I got a note from FINRA saying you need to disclose what TLDR means. And I was like, so you will see in my comments that I have a footnote disclosing what the letters TLDR mean.
Do you have to disclose what CYA means as well?
Yep. Yep. You gotta if you use an acronym, it must be disclosed.
So it sounded like you wanted to jump to a subject. Otherwise, I have one on deck if you want. Go for it.
Not that you and I really care about, I don't want to say we don't care about inflation prints or month to month,
Right.
but it was a hot topic this week. I mean, on Twitter, there was a lot of discussion that, look, it's a bunch of angry people yelling at each other, not really connecting on the point they're trying to make. I think it basically started with Joe Weisenthal from Bloomberg saying there was no inflation in June because the CPI level was basically flat. A lot of other people said no, inflation is still 8.5% because that's the year-over-year number. Other people said if you think CPI, the real level was flat, you're missing the fact that, some of the stuff in CPI is going up, some of it's going down. There's a lagged effect, there's a rolling effect. It's disingenuous to say that inflation was flat for all these variety of reasons. The question I wanted to sort of pose to you was that the way I think about it is when you talk about a headline number like CPI, you're ultimately compressing all this information into one number, right? You're doing, in a way, a big dimensionality reduction. You've got all these underlying components, and you're reducing all that information into a single dimension, one number. And by definition, dimensionality reduction loses information, both noise and signal. So my question to you is, does the market care about that number knowing it's an insufficient number, right? Like, do you think that because everyone looks at the number, it makes the number relevant? Or do you think that everyone looks at the number and then in reality, all the fundamental machinations are happening in the background of what's happening with the consumer and cash flow and earnings and all that stuff ultimately plays out over time, and it's actually not really relevant what the number is?
There's so many things in that topic, and it's one of the reasons I
just wanted to set you up, and I'm just going to turn my mic off and give you 20 minutes.
I was trying to think. There's so many reasons I don't like talking about CPI, inflation, or a lot of times the Fed and interest rates. But the reason I don't like talking about CPI, because like you just said, it's just the map is not the territory. It's just a number. And everybody likes to debate and argue about the number. And the really hard part is everybody has their own unique basket of goods for consumption. So that's why we always argue about CPI. But then there's so many other things that involve with arguing about CPI is, I think I've talked about many times before, is the idea that drives me nuts is everybody talks about CPI as a terrible basket. All of the metrics they use are just incomprehensible. It's not the right basket. And I ask them two questions. One, what would you do differently? And it's always interesting because nobody has an answer, right? The second is, they talk about how shitty CPI is as a metric, and then they turn right around and talk about real inflation rates, which is, nominal minus CPI. So I'm like, you don't get it both ways. You don't get to use the number two ways. But then, like, as you said too, is like the actual individual components of the CPI basket can change over time, and how we measure those metrics can change over time. So like, I think what we were talking about, even in the Cam Harvey piece, what's always been obvious to me is like the idea of changing, real estate from actual real estate prices, I think it was in 82, to owner's equivalent rent. And so how that changes the CPI basket. So we're constantly making these hedonic adjustments to the CPI basket. So therefore, too, you can't look like cross decades unless you go back to the old metrics. And then you use the new metrics for the old metrics, but then you don't have good data. So now you have a data problem. You have a garbage in, garbage out problem. And to me, it was always obvious using owner's equivalent rent being 32% of that basket, that there is going to be a 12-month delay. I thought that was obvious to everybody, but I see, like, that's why I thought the Cam Harvey piece that you posted was great, because it really breaks down. It's like, if you're taking the last month out and updating with the new month, and then people's rent are on a 12-month cycle, it's going to take time for that to work through the system, especially when it's 32% of the basket. The other piece I'll get to before I'll let you go is like, Mike Green and I used to talk about this a lot, that a lot of times inflation break-evens is a way to play oil or energy, and you can use it to hedge or go long, depending on how you want to structure the trade. But what Mike and I used to talk about all the time, but then I started diving into it, and I was like, is that still true? And I'm not so certain it is anymore in the last few years to the last decade. And part of that is now it's only makes up 5% of the CPI basket. Granted, it's the most volatile piece of the CPI basket. So it used to have a lot of effect. But now with what we're experiencing, since the pandy wandy, is the OER being 32% and now it being more volatile is having a larger effect. And you're going to see a 12-month lag or delay. And so I'll switch it to you to maybe talk about the way you structure that. And what Cam Harvey was showing is like, even if we have like zero prints for the next several months, inflation could still go up due to OER or stay flat for many more months, even through the election cycle.
Yeah, so there's a couple points there. and again, recognizing that not everyone is glued to my Twitter feed, nor should you be. The Cam Harvey piece that Jason is talking about, he did a great video 2 days ago, Wednesday, August 11th, that got published by Research Affiliates. It's a 5 or 10 minute video on the most recent inflation print, and he talks about all this stuff. He talks about the fact that the level was flat month over month. He talks about the issues of how we've changed how we measure the CPI, and that if we use the old measure, year over year would actually be closer something to like 13, 14 was his estimate, rather than the 8.5 we're seeing now. So, but it also would have come down more recently using the old measure. So there's trade-offs. To your point about sort of the lagging effects, there was really two components here. One, and I think this is really critical, and it actually is really funny, it ties into another research piece that I'll bring up in a second. But one thing to remember, when we're doing rolling year-over-year changes, we have 11 old data points and 1 new data point, and every month we caterpillar forward and we lose an old data point. So it's really important to understand the data points we're losing relative to the data points we're gaining. So in the next 2 months that are coming up, the inflation prints in the prior year for the month-over-month changes were very low. Like, I think last August, last September, the month-over-month changes were equivalent to 2 or 3% annualized inflation. So if this next month we get an inflation number that's equivalent to, say, 3.5, well, I think we would all say if we had annualized 3.5 inflation, we'd be pretty happy right now. But that 3.5 print over month with a 2.5 print falling off is going to make our 8.5 number go up. We're basically seeing a number fall off that was growing at a lower rate than the new number coming on, even though the new number coming on is lower than the year-over-year change. These are the sort of complicated math things that I go back to like, if you can't explain this stuff or you don't understand this stuff, you shouldn't be quoting the number. And this is, to me, is like a huge thing. Like, if you can't tell me how VIX is calculated, you shouldn't tell me that VIX is important, right? You should understand the details of how this stuff works. To your great point, and this is one that I don't know as well, but Cam, I think, made a great point about the owner's equivalent rent as well as rent itself. If you look at sort of like point-in-time inflation measures, rental inflation is in the double digits. But if you look at what's coming into the CPI calculation, it's only in like the mid-single digits. And the reason that is because the point-in-time measures are looking at new leases. But when you sort of look at cross-country turnover, it's only like 1/12 of the leases are turning over every month. And so you get this lagged effect that if you happen to lock in a lease last January, you know, you're not going to end up renegotiating that lease and feeling the inflation pressure until this January. So you get this smoothing effect. And when you know that owner's equivalent rent as well as rent themselves make up 32% of CPI, right? That lag effect can have a big impact that we could feel well into the next year unless we see rents and owner's equivalent rent drop dramatically in the meantime. So there's all these complicated parts of measuring inflation. The last thing I'll say, by the way, is you mentioned this, like, you can't talk about inflation and real rates. I said the exact same thing to someone the other day who was talking about inflation and then talking about real GDP growth being 0 to negative. I said, you can't talk about inflation and real GDP growth. You can talk about inflation and nominal GDP growth, or you can talk about real GDP growth, but you're just double counting at a certain point.
No, I think you nailed it. And there's so many things I want to address, because also part of your question was like the Keynesian beauty contest of the question, like, does the number matter, or is it the responses to the number or the expectations of the responses to the number, thinking about the secondary and tertiary effects. And that's why, you know, who really knows, but I think it's just, CPI is just a number for FinTwit to circle jerk about, because the actual Main Street economy does not care at all. All they care about is gas prices, and gas prices can be dramatically affected by crack spreads, which are based on refining costs, and refining costs exploded, which, you know, worked through to gas prices. So I don't really know what we're talking about a lot of times, but part of that too is like the idea of expectations. And you and I know it's like everything in finance is really expectations. and whether something came in higher or lower than expectations. And that's what's going to affect the market. Not if it's up or down. It's like, what was the expected outcome by the market participants in aggregate? So that's what always matters more. The other one that reminded me of, like you're saying, 11 months of stale data, and then the new piece of data comes in, the new month's data comes in. The great analogy for me is, for anybody that's been a CTA trend follower, is ATR, the average true range. Like, you're using like usually 20 days of data set, and then that new day is going to affect the volatility calculation that you choose to how large your position size is going to be. So like if you're used to using ATR, it makes a lot of sense thinking about how the 12-month lag in OER is going to have effects.
You're setting me up beautifully, because I
You're
want to
welcome.
talk to you. I want to talk to you about this because it actually caught me off guard. So there was this paper I read this week that was published by, I don't know the author's names. One of them comes out of the Coinbase Institute, and it includes trend following in crypto. Everyone loves crypto, but it addressed this idea of like the caterpillar of the data, right? So a traditional trend following model, for example, might be, I'm going to look at the prior 12 months of data, and if it's positive, I'm going to buy. If it's negative, I'm going to sell. And every month, I'm going to refresh that calculation. Very naive, tons of ways you can improve it, but let's just use that as a base case. What these authors said was, first of all, crypto moves way faster, so they're going to look at 24 hours of data. And here's where things got interesting. They recognize that tons of websites publish the best 24-hour performers on a rolling basis. So if it's not, like starting at 0 UTC, it's, hey, if it's 3:15 p.m. East Coast, it's 3:15 yesterday to 3:15 today, right?
Yes.
Now, if markets are relatively efficient, you would expect only new price information matter. First of all, trend following wouldn't exist, a whole different issue, but certainly all that old information should be incorporated. So something falling off shouldn't be important. Only new prices coming in should be important. Here's what they found. They found that the trend following phenomenon, if you sort of looked at the excess returns and regressed it on which data points mattered, a huge proportion of the strategy could be explained by the fact that data was falling off. That all of a sudden some old print fell off that made the returns look really good. That 24-hour number suddenly looked good, and people rushed in to buy, even though the new number coming on wasn't necessarily any better. And their argument was basically like, this is completely irrational price chasing behavior, not even related to like price number go up right now and so we want to buy, just that people weren't considering the fact that the old number was rolling off, which would make the new 24-hour number look really good. They were just screening on that 24-hour number. And so if you knew that, you could sort of calculate hours in advance, hey, I know that number is going to roll off and suddenly that 24-hour number is going to look really good, you could front run that flow, which again is just sort of like, okay, do you blame it on irrational investors just making very silly screening decisions as to what they're trading? Hard to say, but it sort of was like one of those mind-blowing, like, I can't believe this is real. I can't believe this shows up in the data.
Yeah. My favorite part, yeah, like you're saying, is like with using crypto markets versus TradFi, is like when you're looking at any sort of crypto market aggregator and you're seeing whether the market's up, Bitcoin, Ethereum, or any altcoins up or down, it's like it changes every 15 minutes to hour. Like that's where it's like when we look at like SPY, because the market actually closes, the day changes actually are actual day changes or intraday change, like where like you said, it really matters what time you're actually looking at it. By the way, you threw me off for a second there because you said the caterpillar effect, and it made me think about the centipede effect from South Park. So I'm not even going to get into that one.
I just want to point out, Tyler behind the scenes is just clipping his heart out right now with you. There's some real Friday afternoon attitude coming from you.
It's not me. And I actually don't like to be a soundbite person, but also I want to point out that this is our 1-2 punch, or our straight man comedy man kind of trade off. Is also last week I was having all kinds of problems with my internet feed, so I did all this I'm hard plugged into Ethernet cables and everything, and now your feed's going down. So one of these days we're gonna get our shit together.
This is what happens when you live a nomadic lifestyle. You never know what internet you're gonna get.
So you were because you brought up crypto. There's a few other things I want to kind of touch on in the crypto space. One is what happened recently with Tornado Cash. and North Korea and OFAC. And so I would want to give a shout out to Byron Gilliam at Blackworks. Actually writes a great blog on the crypto space. Very short, like comes out every day, and it's really good. But he was talking about the actual, OFAC stands for Office of Foreign Assets Control. And you can be, specially designated nationals, right? Which is basically like kind of terrorism guidelines to who banks can work with. And so OFAC decided that, Tornado Cash is a problem because they're saying they're taking money from North Korea. And now this has sent shockwaves potentially through DeFi, where everybody's like, well, these DeFi protocols are running on their own, whether it's Tornado, whether it's, Aave or Uniswap, you can't shut them down. You're never going to stop us kind of thing. And it's like, as soon as OFAC designates this as like maybe a terrorist website, good luck using the off ramp of like banks or anything to actually get your money out. And so I'm just curious, your take, like this is like, I think sending shockwaves through crypto right now,
Well,
but maybe I'm wrong.
No, it's definitely sending shockwaves, and I think people are trying to figure out how this applies. So, you had some people said, well, I used Tornado Cash just to see how it worked 3 years ago. I sent 1 ETH through it to myself, and I've been using that wallet ever since. Now both of these wallets are poisoned, right? And how am I ever going to get the money out, right? This wasn't nefarious. It's just something I didn't know about. So you have gotten, I think, a little clarity that now says something to the effect of like anyone who's used it after September 2021 is getting sort of marked as like a poisoned wallet. But then there's, some joker, and I found this pretty funny.
This is so good.
Was just basically taking 0.1 ETH and sending it through Tornado Cash to like major wallets like Andreessen Horowitz and stuff, and just being like, fine, we're all poisoned. Good luck, So yeah, it's a tough one. Like again, the protocol is written to be the protocol. You could argue, why does this need to exist? But on the other hand, like there's plenty of great reasons you might want financial anonymity. I don't need it at the moment, but I can see true use cases, and honestly, it's probably one of those libertarian versus government oversight and regulation issues. I don't know. This is a sort of a scary one of people saying, no, the whole idea of this decentralized finance was like pseudo unregulated. Everyone takes care of themselves, and then you're seeing the big swinging arm of the law.
That's what you want to call it.
Yeah.
So I wonder if my memory of history serves me correct, is when we started confiscating gold in the 1930s, we never actually really confiscated gold. It was more like you would be considered a criminal or outlaw if you actually held gold, and that's enough usually to make most people comply or capitulate, kind of thing. And so like same kind of thing now is like it's just kind of, to me, this classical thing is like, well, I'm gonna do it, Tornado Cash, I'm gonna use tumblers, I'm gonna do all that stuff. Yeah, that may work as a single man or whatever. And then as soon as OFAC starts handing down these rulings or laws, and then more importantly, a lot of times is like, as soon as you have a significant other or start a family, all of a sudden you're going to stop that kind of behavior because of the consequences of it. And a lot of times, so it can be just as something as OFAC making this ruling. That's why I'm saying it sends that kind of cascade of waves through that makes people very fearful. By the way, I don't know if this is a pro or a con for your use of an Android phone, which drives me crazy. But like, so you never get to play the game on an airplane where you can just airdrop like crazy photos to everybody on the airplane that has Apple products.
Right. Yeah. Again, it goes back to a new precedent has been set. I think Tornado Cash was always sort of on the edge of, everyone knew there was lots of nefarious stuff, like all the hacks and on blockchain, like the money ended up getting put through Tornado Cash. So it was clearly being used for nefarious purposes. I don't have the evidence on hand that it was tied to North Koreans in any way or being used to wash money and send to North Koreans. Like, I would hope the government, if that's their claim, has great evidence for that, but I don't think they're going to hand it over to me. So yeah, it's a tough one, man. It does raise interesting questions of, okay, if I use these other protocols that Aave or Uniswap or something like that, and it turns out I'm interacting with a North Korean, hacker on the other side of the pool, and I don't know it, like, what's my real liability here?
Right, and as you brought up at the beginning, like, how far are they going to go back too? And like the other question I had for you related to crypto is, it looks like ETH is making the proof of stake switch, But what's interesting now, you're gonna have two chains, right? You're gonna have a proof of work and a proof of stake switch. They don't know what they're gonna call them yet, right? Is it gonna be ETH1, ETH2? Is it gonna be ETHPOW, ETHPOS, which makes me laugh every time. So then part of that is like, what do you do with like NFTs, right? If you own like a Mutant Ape or Bored Ape, now you have two versions of it. Which one's gonna be more valuable to you?
Well, there are some big questions here, right?
Right.
Because let's just start with this. Let's start with here's what's going to happen. There's going to be a fork. At a certain block, there's going to be a fork, and you will now have a complete duplicate wallet of all your assets on a separate blockchain. So suddenly, you have two of everything. Are you now twice as crypto wealthy? Well, let's start with the obvious. What happens with USDC, right? The stable coin that's pegged to the dollar that is literally backed dollar for dollar by Circle. Well, now there's twice as many USDCs in circulation as there is dollars. So because of the fork, they are no longer one for one. Now, what Circle has said is we will not support USDC on ETHPOW, the proof of work chain, the old one. We're fully supporting the proof of stake chain. So that means all the USDC on the old chain is suddenly worthless. So you have to ask, okay, what sort of cascades are going to happen from a liquidity perspective that USDC that was being used as collateral that now should go to zero goes to zero potentially, right? To your point, okay, now there's two of every Bored Ape. There's two of every CryptoPunk. Do people suddenly say, well, the old OG CryptoPunks on the proof of work are more valuable because those are the originals? But the Bored Apes who have more of a community and use their tokens for utility will say, no, it's actually us. It's the proof of stake and the old proof of work ones. I've been chatting with a ton of people about this. I think the answer is the proof of work chain is going to just go to zero immediately. All the oracles are moving over. All the stable coins are going to support the new proof of stake. And there's going to be no way to interact with it really. Like Etherscan is the website that's going to move over. Like OpenSea, that's just going to move over to proof of stake. There will be no way to interact unless you know how to call contracts directly through code. And without any sort of user interface, I have to just imagine it's going to die. Unless, now here's where it could get interesting. Let's say a centralized exchange, for whatever reason, decides it's going to accept, let's call it ETH proof of work, the old ETH. Is there going to be a scramble to figure out how to get as much ETH proof of work through however you can on the old chain, send it to that centralized exchange, and liquidate it as quickly as possible to move it over to ETH proof of work? Proof of stake, excuse me.
Proof of stake,
I don't know. But it seems like there could be some weird money-making opportunities here. And worst case scenario, it's going to zero anyway is my presumption. So you can try to make money, and if you lose it all, okay, doesn't matter. It's all going to zero anyway.
But also, in a way, I mean, it's not quite perfectly analogous, but ETH Classic is still a multi-billion-dollar market cap.
Yeah, this is what confuses. This is where my TradFi brain might just get in the way, and I say you cannot just double every asset without cutting the price in half, right? And yet, if you go back to prior forks, that's not what happened. It's not like the market cap got cut in half. It's like there were people who still wanted ETH Classic and retained its value, and there's people who wanted the new ETH. I don't know, man. This is one of those, I think I know what should happen, but crypto's still a world where what should happen is not what necessarily happens. It is true Keynesian beauty contest because most of this stuff has zero utility.
Yeah, because like you said, our brains work in no arbitrage conditions of TradFi, so it's hard to wrap our heads around sometimes. But there was a small piece I want to pull out of there for you. Is you said that the difference between apes and punks is, my understanding, a lot of people, at least right these days, they like to, narratives change, but they like to talk about punks as the provenance, right? That was the first real project that gained traction. So do they stay on the POW chain because that shows that original provenance? By changing it to POS, are you changing that idea of that's the provenance, but it doesn't matter which chain it's on?
So what happens, here's a question for you. What happens with all the copyright, right? So you have, as an ape holder, for example, yep, you have been granted the right to use your Bored Ape however you want. Now there's going to be two of them. Who has the rights? The old one or the new one? I mean, how do you, I don't even know how you would like declare that. Do you have to, as Yuga, who's already given the rights to you via the token, now the token's cloned. Yeah, I don't even know how this would work out in the court system. Because I don't think we've ever had a precedent. Like, there's no case for this, right? Not that I'm aware of. So this is like a really
There's no case law for this.
like, not that I'm a lawyer, but I'm trying to imagine like a situation where you have an identical clone created and a question as to where copyright has been granted to the owner of the first digital item. There's a clone, and you actually want the copyright to probably go with the clone, right? You want to move to the proof of stake. You don't want the original uncloned. So it's kind of wild. I don't know how this is going to play out. It's pretty fascinating from the outside in. I really do think my bets, not that I have any monetary bets on this, but my bets are the ETH proof of work stake is just going to dwindle to zero. And maybe it just becomes, in the meantime, some weird playground for pump and dumps.
The only other piece, I forgot to text you about this earlier this week, is Sergio Silva was on the podcast My Life in Four Trades with Maggie Lake in like Real Vision, and the whole podcast was about how he basically, how do I say this, had his CryptoPunk confiscated or recollateralized. So basically, he's been really vocal in the NFT and crypto space. And so he was experimenting with DeFi loans on his CryptoPunk, and it was a 30-day loan. And I think when he put it into his computer, like for his calendar to remind him, he would put in like August 4th instead of August 3rd. So he was a day late. So the DeFi protocol, like, obviously liquidated the loan and took back his collateral of his punk. And then he's only, I think, very lucky in the sense that because he's got such a broad community in the crypto space, everybody went crazy when he told them what happened, and he was eventually able to find contact with whoever set up the DeFi like protocol, and eventually get his punk, buy his punk back. But like, this is another thing about this Wild West of like, you can't fat finger mistakes, etc., mistakes in general. Like, there's no recourse.
Yeah, there is no recourse. And there's a couple protocols out there that do that lending on NFTs, which I think if you're outside the space sounds insane. Like, how can you get a loan on a picture, a token that points to a picture? I know it sounds crazy, but it happens. And the oldest one I know, I think immediately, right, if you didn't meet your collateral needs or after 30 days didn't pay back the loan for the term of the loan, it would just take it. And I'm not 100% sure what happens with it. I do know there's another protocol where you can actually buy insurance at the outset of the loan to give you the ability to buy back at a certain price if you don't meet your collateral needs within that window or for whatever reason. And then after that, it goes to auction, which is kind of interesting. And that happened a while ago. So that one's called JPEG'd. And they had some CryptoPunks go to auction that then people just bid on them. So it's pretty crazy. You do see this stuff. And I personally think it's tons of fun. I know tons of people are just very anti-crypto. I think look, people are getting hurt, and that's not a good thing, and people are being taken advantage of, and that's not a good thing. But I think for the financially savvy, it's a very interesting playground where you have all these Lego pieces that are being built on top of each other, and they're just sort of speed running finance on, I don't know, acid.
Yeah, if you look at an experiment, it's just fascinating to watch the experiments. But like you said, I think plenty of people that have coded up algorithms to sit on like OpenSea and other platforms to just wait for people to make a fat finger mistake and just swoop up and grab their punks or apes. And so, part of my personality when I heard about having the Sergio, I was like, oh my God, that's kind of brilliant for to have a loan to own kind of protocol where unfortunately you're taking advantage of people, but how is it any different from like Elliott Management or all these other people that they provide loans knowing that people are going to default, and that way they're basically buying with a margin of safety?
Yeah, I mean, the expectation is you will have defaults, right? That's part of like when you're making a loan, that's part of the terms of the loan, and you bake that into the price, like that there's a certain default rate if you diversify across enough of these. So yeah, I think it's a very fascinating concept. And again, I know it seems very strange that you could get, $100,000 loan on a very pixelated character. But again, for some people, these things have a tremendous amount of value. And if you can get the loan and you're willing to pay the yield, then so be it. It's a liquid enough market that I think it still makes sense.
So we started talking about, CPI, inflation, the things that we don't like to talk about, and the other things like we don't like to talk about is Fed and interest rates and those sorts of things. So I was thinking about this. Some of my favorite things are trying to steelman both sides of the argument. And if you do that properly, my question is always, what are you left with, right? If you steelman both sides, what do you do, right? And that should affect how you construct portfolios. You shouldn't just steelman one side and then adjust your portfolio 100% to that side. Because once again, what if you're wrong? Everybody always wants to talk about what if they're right and they have this great idea. And I'm like, I have all of the behavioral biases. Like if you tell me about you have a great thesis on a stock, I'm liable to like think that's a great thesis. Like I'm going to fall for it. But the question is always like, what is your position size and what does the rest of your aggregate book look like? Then we can actually talk about it. I don't care about your thesis, but everybody focuses on the wrong thing. Everybody wants to be a genius and get their thesis right. And then it becomes very gladiatorial across all our entire industry. Most of the time, people are just talking about a very individual thesis and whether it's right or wrong. And that's what they argue about. And I'm like, this really doesn't matter at all. But it reminded me of this morning, when I was walking, I was listening to, Peter Zeihan on Grant Williams' show. And I was just thinking, because I'm a glutton for punishment and I want to scare the shit out of myself. So I like listening to Peter Zeihan. But it's interesting is like, one of the things Peter obviously talks about is demographics. That's his primary geopolitical scope is demographics. And it's a lot of people, and I think this is a very compelling Steelman argument, that demographics are baked in. And by 2047, something, we reach peak population of like 9.7 billion or whatever. So like we have this, what he would call a demographic crash, right? And there are a lot of people think that's baked in. But I have seen anecdotes that we had that same fear in the 1920s.
When you say baked in, like that's guaranteed to happen, or baked into price?
Almost like, well, no, like not to price at all. Like just the actual population numbers based on almost like when we were talking about CPI as a lagging indicator is, you have birth rates around the world and you know what it's going to look like 20 years from now based on today's birth rates, right? Very simple, like kind of lagging indicator kind of thing. And we have we have population attrition around the world. People are having fewer and fewer babies. And so therefore we feel, especially the westernized world, we don't have that replacement value of people like in family formation. So that's why people think that peak population is already kind of baked into the process. At least if we, once again, with the caveat of we, in quotes, continue on the course we're already currently on, right? And so I had maybe found a few months ago an anecdote that we had the same fear in the 1920s. And so I've been trying to find literature or old newspaper clippings. I've been trying to find more on it. Can't really find it. But the countervailing thesis is great is Russell Clark has been talking about it a little bit. And he can steelman an argument with the best of them too. And so I like to see that other side because I'm somebody that population. So let's talk about the other side because we don't have really the economic models for peak population. Like you were talking about GDP before. GDP is based on the idea of population growth, right? And consumption. So we don't really have a model for what if we have population attrition. So talking about the other side, Russell Clark was calling them neo-Malthusians. And I would actually call them maybe anti-Malthusians. But basically, for people that don't know, Malthus, I think it was in 1799, was proclaiming that we were going to run out of food to feed the population. We were already overpopulated on the planet. Of course, based on technology, he ended up being wrong. And the carry capacity for the planet for the population is whatever it is today, as far as I'm concerned. Like however many people we have today, that's our carry capacity. In the future, can it be more or less? I don't know. We'll find out when we get there, right? Like, but the technology, the green revolution, all of these things keep and ag tech keeps helping us and everything. But the one thing that Russell Clark brought up that I thought was interesting is he believes that technology could potentially change this as well, in the sense that as we have, one of the key statistics everybody shows, our mothers are getting older and older in the Western countries, the Western Hemisphere, before they're having children. And so that's also reducing, obviously, the population size. But he's showing, the technology via IVF is getting better and better. But then people are like, well, IVF can't work past a certain age. But then if you combine that with donor eggs, now you've increased that ability to have kids, right? And then those donor eggs, we can then start looking at frozen eggs. And the ability to freeze eggs and them last longer is getting better and better. So his argument is like, you have a lot of these technological changes, so then it becomes down to a political change of when do they start to support like IVF, donor eggs, and fertility issues to reignite the population growth, let's say in Western Europe or Japan. US we're pretty much okay, especially due to immigration. But it's an interesting argument of trying to steelman those both sides, where I think a lot of people are reaching more towards that Peter Zeihan rule. Like when I was kids, everybody was talking about we have way too many people. People should stop having kids, right? Now, in my 40s, and everybody's talking about we're not having enough kids. and now we're going through a demise. So it's like it's interesting to always talk about what are the steelman arguments on both sides of this discussion.
I can't say I have any real view here other than it is a fascinating topic. The one thing I always think about when I hear about population growth, right, which is an important component of economic growth, is right the stability of that growth in a confined world with a finite amount of resources, right? And technology can help us stretch those resources. But at a certain point, do we simply have to accept lower economic growth as a world population to ensure that we don't annihilate ourselves, right? If you sort of are a believer in terms of our impact on the environment and the potential disastrous sort of tail outcomes that could occur, right? So like in isolation, ceteris paribus, it's like, yeah, have babies. Great, we need that. That's one of the best things we can do for our economy over the long term. Look at what's happening to Japan when you don't have enough babies. On the other hand, if it's like, yeah, everyone should be having 5 or 6 babies, not just replacing themselves, but let's pump up those rookie numbers. It's like, well, we also have to pump the brakes here and think about like the left tail catastrophic impacts we can have of sustaining that population that could actually be a massive negative GDP outlier, right? Your population is not productive if they're all starving, right? And so, and a lot of that stuff can end up going into like those pro-cyclical negative spirals. So I don't know. This is one of those like really interesting things to me of like, okay, peak population, like, is that a bad thing? Do we need to keep adding more people? I get that it's this relative jockeying of if the U.S. isn't and China is, and we care about our relative economic output as countries, and we're not all behaving ourselves and kind of trying to control population growth to a sustainable level. Obviously, we want to replace people. But again, like I don't know what the optimal number of people on Earth is, right?
Right, and that's right. And I'll maybe tie it back to like you're saying for us to have like an opinion about it in the sense that like I just think it's also interesting to see how it's changing in the zeitgeist or the Overton window, because I saw a clip of Elon Musk was on the Nelk Boys podcast, and obviously Elon has 9 kids, which was a big part of FinTwit maybe a few weeks ago, but he was talking about something similar, and it's interesting to me how that narrative is changing. And I think Haskell has been making the podcast rounds talking about effective altruism, and they can come down on both sides about whether you should have kids or have a lot of kids. And I know Haskell himself, I think, leans towards having more kids. And so it's not that much that, like you said, like we build portfolios and we have products. So like, what can we do about it, especially if it's decades off into the future? But the way I think about it is, when we build portfolios that have, try to hold a lot of like the world's asset classes and rebalance between them kind of idea is like, if I can kind of garner all the world's assets in a Meb Faber sense, right? I want to hold every productive asset in the world. And that's a properly diversified portfolio. The question though is people always ask me like, what keeps me up at night? Well, the 2 things that keep me up at night is that portfolio makes sense if I look back at 100-year history, right? But if I look back at 100-year history, that's kind of an anomaly, and it's kind of one data point to me, because if we think about the full advent of the Industrial Revolution, we went from like 1 billion people in the workforce to like 5 billion people in the workforce now. Are we going to see that kind of workforce population growth again in the next 100 years based on what's baked into the population now? Doesn't look likely. We may see like a 50% increase, right? But then if people start having kids again, that can change. So once again, it's like, even though your portfolio looks great over the 1900s into maybe 2022, is it going to look great in the next 150 years?
How do you back out the impact of doubling the workforce over the last generation by having women enter the workforce in a very meaningful manner, right?
Exactly.
Like,
these are things we don't talk about.
That again in the U.S. again, like that's a one-time shift that happened. So look. I think you and I would ultimately just throw up our hands and say it's impossible to disentangle. So anyone who has a strong view on this, again, I go back to like this problem of data compression and dimensionality reduction. There's so many moving pieces that if you reduce this to a single dimension of just population growth is the only thing that matters, you're missing all the nuances, right? That can, the chaotic effects that just a subtle change into one of the inputs can lead to a dramatically different output for a lot of this stuff. Not just like, okay, where do we peak potentially, but what sort of impact does that actually have? If someone suddenly invents ways to very efficiently produce food with less water, if we start taking advantage of physical high rises for growing plants on buildings and stuff like that. Like, you don't know what sort of cultural or technology changes we are going to accept as a population and embrace that could have a dramatically different, lead to a dramatically different outcome. So with this sort of stuff, particularly 20 or 30 years in the future, like, you ask anyone to imagine what the future is going to be like, they're just wrong. They're always wrong. It's never right. The history of human imagination is like just wrong on predicting the future. So I don't know why we take any of this as like serious discussion, candidly. It's a little mind-boggling to me.
Yeah. Like both of us are long entrepreneurship, like long human ingenuity. But I want to talk about two things you brought up just to like tie it kind of full circle back to what we even started talking about on this episode of the show. Like you're saying, it's, GDP is population times consumption. And the other thing that keeps me up at night is consumption, right? The way we've historically looked at consumption in our economic models could be vastly different. For example, maybe not these sweaters, but maybe these sweaters, but like other sweaters, like if I'm going directly to the source, like a company like Nadam, right, that is using Mongolian cashmere and going direct to source, and I can buy direct from the source, I may still buy that sweater, but it may cost me 1/5 of the price. So consumption may go up. Meanwhile, the actual dollars or price I'm spending on that consumption may go down, and we don't really have economic model. Right? Yeah, that we're reducing the rentier class and the middlemen through the abilities through the internet and globalization to go direct to source. So that can change things dramatically. The other one that I want to tie kind of a little bit back full circle is, when we were growing up around the time both of us were born, the real buzz was about the emerging economies, right? That was where the future was, and that's where you could stake your claim, and that's where the exponential growth was. Well, to me, the new EM may simply be the emerging metaverse. So like you're saying, is like maybe there's more of us on the population, but if we're all hanging out in the emerging metaverse, then we're maybe not consuming as much actual raw commodity goods, and the planet may have a higher carrying capacity. And the other reason, sorry, go ahead. You want to say something?
No, go ahead. Go ahead.
No. But that
I'm going off on a weird tangent after this.
No, I was going to stop there because I want to tie it back into something else you said, but I want you to go off on your tangent.
Well, so you talking about the metaverse, this is going to be a crazy tangent, and thinking about the Fed and political policy and all this sort of stuff always makes me think, how cool would it be, this is really going to show my nerdiness, if you could like sort of hand over a massively multiplayer online game to like central banks and be like, run your experiments here. Like, you think you know what you're doing? Here's World of Warcraft. Go change the interest rates. Like, see how players actually react. And I get it's a sandbox with rules that don't perfectly replicate what's happening. But like, we have so much trouble constructing artificial economies, and we have to like do things in massively multiplayer online games to create sinkholes to prevent runaway inflation and control prices, because part of it is players don't behave in games like they actually would in real life. Like, they just sort of like run all over the world and murder everything, and like as fast as they can accumulate wealth and gold, they do. But that's what I always think to myself, like, you have this sandbox game. It would be really fascinating to try to test out these actual economic ideas and policies in real time. Be like, okay, what happens if all of a sudden we airdrop 1,500 gold pieces to every single user in World of Warcraft? Like, what happens to the price of goods over the next 6 to 12 months? Oh, holy shit, you see a massive run-up in goods prices and then an economic collapse? Or like, what happens if you were like, think about this. Okay, I'm really going off on a tangent.
Great, please.
But what if the developers were like, we are going to create some sort of virus in the game that if the players get too close to each other, can transmit and kill them, so they all have to be forced quarantine and no one can go out into the wilderness, and like all of a sudden the economy internally collapses, and they airdrop gold, and they like literally try to replicate what happened in COVID. Like, how I would be fascinated to see if you end up with the same outcome to a certain degree. And I get video game constraints are not real world constraints, and there's all sorts of caveats, but I just think it's such a fascinating sandbox to play with economic concepts, and I'm sure the players would quit immediately.
Well, like you said, because if it's top-down structured, but I'm glad you went on that tangent because you illuminated what crypto's so fascinating for you, and like it can be tied to things like states' rights or whatever, because we're running experiments, and like you're saying, like we're iterating experiments, and I know this is one of the crypto's arguments is that we're iterating experiments at such an exponential rate with DeFi and CeFi and all these other things that everybody's playing around with. Now, granted, you and I don't want to see people lose money in that, but we are running these experiments in real time, and we get to see thousands of different iterations and examples, and that's part of crypto is like you have to keep up so quickly because the world changes from day to day. But like you're saying, you almost don't need the central bankers or anything to run these experiments. They're being run on their own from a bottom up sense. And once again, we can take from the good, and block the bad, like what's the harness the good, block the bad kind of thing. And so like part of it, I want to tie back in, by the way, because I know this is like, it's fascinating to both of us about crypto. But it goes back to like what I was saying about people are talking about the wrong things when people want to give me their investment thesis on a single name equity. Like, I just don't care. It's like, what's your position size and what's the rest of your book look like? Do you know how many people privately talk to me about you being involved in crypto over the last few years? And whether they think like you're insane or they love it, like either way, right? And all they want to talk about is, what Corey and I love what he's doing in crypto, or Corey's insane what he's doing in crypto. And my question is always like, what percentage of his net worth do you think he's allocating to this? Like everything, all your arguments don't matter.
Yeah,
What percentage of his net worth?
That is the right question, right?
That's it.
That is the right question. And it's a little hard because like you don't just, it's sort of taboo to just put out there what is your net worth, right? And so I can talk about different things and like I try to be transparent. I'm like, I made this trade or I lost this much money in a DeFi hack. Like I lost a whole bunch of money in cream finance, and like I recognize the numbers are probably larger, and for a lot of people would be like, wow, that's a lot of money, and it is a tremendous amount of money. First things first, I'll say I got in at a time that a lot of the crypto pumped way up, so a lot of the money I lost, I don't want to say it was house money, but it was like, okay, like if I put 1% of my net worth in and it goes to 3%, right? Well, okay, and then it falls back to 1. I'm fine. Like it was always meant to be, I'm experimenting with this. I don't know what's happening. I'm just trying to get actively involved. And I think you're spot on. Like people have said the same thing to me. They're like, you seem like you're allocating a ton to crypto. And I'm like, I'm really not. I have 1 to 3%.
Well, it was like what we talked about last week, almost path versus terminus. But you've also highlighted, you actually have a different problem. Like you said, when these prices expand, you can't really rebalance your ape with the rest of your portfolio. So it's a different problem. It's actually the success. It causes you a bigger problem than anything else. If you want to rebalance across your aggregate portfolio and keep that in percentage terms in relatively the same way on your rebalance, it's very difficult to do so. So it's actually kind of an inverse problem, or a good/bad problem to have.
Yeah. Yeah, I mean, look, I recognize that, like, for a bunch of people, flipping JPEG seems like a very weird hobby. But I don't know. I'm sort of the view, like, if there's a market to trade, like, why not learn how to trade that market? Why not learn the nuances, what's driving it? You never know how that will cross-pollinate into other concepts. Like, crypto is one of these markets that is almost pure flow. And so when you hear about people being flow traders in equities or fixed income or different markets, and that's their edge, they're looking for flow, and they're trying to take the other side of flow or front run flow, whether it's index additions or deletions or buybacks or whatever it is. Like, there are traders out there that this is their sole edge. Well, if you're young and new, it's a lot easier to do that in a place like crypto than it is to try to do that in a very active market like global equities or global fixed income, where you just might not even have the ability to do it. And so I don't know, I'm just of the opinion, like, as much as it's a playground, it's also a place where it's easy for me to experiment with different trade ideas and run different studies and try different things and see if they work, and then see if I can port those ideas back to the world of traditional finance.
Yeah, and I could argue that we almost have a fiduciary responsibility to spend our nights and weekends educating ourselves and playing in this new world, because, like, take it back to the 1960s and 70s. CTAs and trend followers were new on the scene, and nobody wanted to trade commodities. These guys were swashbuckling lunatics. And it's like, now that's become an old market, right? And so similar things, as like Meb was talking about, people used to always call him up and be like, what's up with these EFTs? And he's like, well, they're ETFs, but like, I want to like kind of take this almost to inside baseball, and you'll see where I'm going. Sorry, did you want to jump in?
I hope you're going where I think you're going.
All right. So all the homies were kind of on a podcast this week with Meb for Meb Radio. So you had Michael Batnick and Ben Carlson were on Meb Faber's podcast for Meb Radio episode. And I don't know if you're going to think I'm going here or not, but part of it was
No, this is not where I thought you were going.
okay. Well, then we'll have you take it back in a minute. So, but what it made me think about, the inside baseball was for the first 20 minutes of the show, they were actually talking about creating content, and Mike and Ben were talking about, everybody goes, if you're creating all this content with your podcast, your blogs, etc., when do you have time to run your business or whatever? And they're like, well, a modern business now is content is the business or part of the business. And so you and I kind of talk about this a lot behind the scenes. It's like, yes, we run businesses, and then our nights and weekends or our spare time are devoted to creating this content. But I think it's almost like crypto is there has been a shift in the zeitgeist, whether it's generational or not, where transparency is more valuable than it's ever been. And you and I talk about this often, is by us doing these podcasts or shows off the cuff or doing whatever, it's we're putting more content out there so people can get to know us better. It relates to the sense, I was listening to one of my favorite podcasts is Founders, which is basically he just reads books of founders. And one of the ones he was reading recently was about Howie Cohen. And even in that book, he was talking about you have to project that you know what you're doing, so then everybody will think you know what you're doing. And I'm I think that's a boomer mentality. I think for lack of a better term, don't peg me as generational kind of thing in this argument, is the zeitgeist has shifted, and projecting that you know what you're doing no longer works. It's here, it's showing that we're learning in real time. We're doing our best. We're showing who we are as people, instead of seeing the old school hedge fund was the wizard behind the curtain and you never got to talk to them. Well, the zeitgeist has completely changed. And to me, Meb and Mike and Ben really get this. And this is what they're building, multi-billion-dollar AUM companies around the idea of content is king. And people really buy from people. And the generational shift has happened is I don't want to buy from a nameless, faceless corporation. I want to buy from somebody who has a similar value set or thinks somewhat similarly to I do, or I just like the cut of their jib, or I like their pirate sweater. It's those kinds of things where and it's the same with crypto. So it's you have to stay up on these things to kind of evolve with where the business landscape is shifting, instead of calcifying your thinking and wanting to hold on to like a gold bug or something, or to sound money when things have dramatically changed.
Yeah, I think Patrick O'Shaughnessy really helped pave the landscape here, especially in the world of finance, of this concept of learning in the open, being willing to say, I am here to learn. We are all constantly learning anyway, so why would I be ashamed of asking questions in public? And then using his podcast as a mechanism, right, to learn. And then as he learned, he got more and more people on it. So Patrick became known himself. It increased his brand. It increased his reach from a marketing perspective. It increased his personal network, right? And it is constantly increasing his knowledge and what I call his, outer brain. Your network is your outer brain. Your personal brain is only confined to so many things. But when I have a very particular problem, I have a network now that I can tap into. So I'm sure you feel the same way about your podcast. Flirting with models for me, yes, it is marketing, 100%. Everything, I run a business. I need to market somehow. So flirting with models is absolutely marketing. But it's also a chance for me to talk to brilliant quants that I can learn something from, both on the air and off the air. It improves my network, both people who are listeners that want to be part of my network that might not be customers, as well as the guests that I can reach out to and talk to at any time and develop relationships with. So it's a multifaceted thing, and people who plug it as just, oh, it's just marketing, I think are missing the big picture of how valuable something like that can be. Creating content is a phenomenal way to find an audience, have a conversation, work through your own thinking, right? Get challenged by your guests or your co-hosts or coming up with topics. I mean, the amount of stuff you and I that doesn't end up in this show that you and I fire back and forth every week, I mean, we could probably make it its own thing, right? Things we didn't talk about in the show notes type situation, right? Things we missed.
Yeah, the BTS, if you will, and that's what you're saying. It's I hate trite phrases, but the idea of your network is your net worth, and it's always amazing to me. We both have these amazing Rolodexes for anybody who can remember what those are, where like you said, it's the hive mind. We can tap into experts and all these things, and that's where especially Twitter DMs have been incredibly accretive to both of us. And then especially you getting more involved in crypto, that really widened your network. And I can tap you with any question, and within one or two people, it's like the 6 degrees of Kevin Bacon. To me, it's like it's the 2 degrees of Corey Hoffstein. I can tap into any expert in the world via your network. So I abuse you tremendously.
I always like, I'll give an example. You were talking about break evens earlier. I was looking at a new ETF that has come to market that has inflation swaps in it. And I know what an inflation swap is. I, in theory, went through all this stuff in my grad school programs, but I have never traded an inflation swap, right? I know what a break even is. I know how to go long tips, short treasuries. I know, in theory, how you're going to hedge that. But do I know the subtle nuances of why that trade can go against you, or why you might choose an inflation swap versus a break even? No. So what did I do? I went on Twitter and I said, okay, I found a couple of things in banknotes and stuff that I'm researching as to like what some of the subtle nuances here. People who trade this stuff, what do I not know? What do I not even know to ask questions about? Because I know so little, right? And there are some really important nuances in this stuff that you're not going to know unless you're a practitioner. And so being afraid to ask other practitioners is just leaving a huge gap in your knowledge base, which brings me to where I thought you were going.
Yeah, please.
Not knowing what you're getting into is the path I'm going down. And I want to talk about a YouTube sensation known as Meet Kevin.
Oh, yes. I totally forgot we were supposed to talk about this.
I know we're already over the hour, but this is worth talking about.
Yes, please.
For those who have never heard of Meet Kevin was is a YouTuber, very successful YouTuber. I think over 1.8 million followers right now. Started pre-pandemic in the real estate space. Really was one of those people who was very into the buy a home, fix it up, get some renters, take out some of the equity, buy a new home, and do that over and over and over again, which worked phenomenally in the 2010s, right? Sort of hard to look back and not say what a great trade. On the other hand, there's many things that could go wrong with it. So neither here nor there. Did incredibly successfully well for himself. Always said he would never talk about stocks. The pandemic happens, lockdown, real estate disaster. And he, at least according to sort of like his videos and what you can piece together, basically took out refied and took out a ton of equity from the properties he owned and piled it all into Tesla. And basically made something like $20 million over the next year and a half. And in the course of doing so, talked about it nonstop on Twitter. Not on Twitter, on YouTube. And grew a massive following. And he and a couple other guys in that sort of YouTube finance space all came together, and they would have a podcast together and all this sort of stuff. Long story short, it's been like... I'm embarrassed I know as much about this as I do, but I sort of kept... During the meme stock mania, I actually thought these guys were influencing markets to a certain degree, so I kept my eye on what they were saying and their sentiment, because I thought it was sort of a good sentiment indicator for retail investors. Long story short, he is now launching ETFs. By the way, at the beginning of this year, after telling everyone that stocks for the long run, he sold everything. So it was like a huge whiplash for everyone who follows him. But he sold everything, and you and I were going back and forth going like, the worst part is he's probably right. like if I was going to make a market timing call, it did feel like that was the right market timing call. Not that like we can do all in or all out in our mandates, nor would we want to, because that's like huge tactical bias. But long story short, so he makes this brilliant Tesla call, brilliant in quotes here, then makes a brilliant, in quotes, all-out call this year. And so now he is launching 3 ETFs. And I think to myself, I know from the outside it seems like a sexy business. I know from the outside it's like, wow, I've got 1.8 million followers. If they all just give me $100, like I'm going to have so much AUM that I'm just clipping. But you don't realize the pain you're getting into in launching a product. until you have start. I was talking to my lead analyst today, and we have a weekly meeting, and we're recapping the week. And he said, honestly, I didn't get as much done this week because I had to spend 3 days just filling out paperwork for the SEC. And I said, this is the stuff that they don't teach you. They don't tell you what you're going to get when you do this. And it's the same thing I keep saying to you. Like I know the grass is always greener on the interval fund side or the mutual fund or the ETF. It's not greener. It's not greener over here.
Or your favorite, they just have to look at your tweets about DDQs. But I will push back on this one in a different way. And by the way, it was fun to watch all of the whole tweet thread after you posted this, because man, is this polarizing topic. And by the way, I do not appreciate that you tagged me into it, because now my Twitter was blowing up like the on the badge. It was less like every day. It's like, Jesus, what the hell happened? It's just like dozens of replies to your tweet, because obviously somebody like that is quite polarizing. I think about it the other way is, you'll have to remind me what the exact verbiage is, but like when you have an ETF and you have an ETF index, you can actually be on the marketing side and not the ops side. And that allows you to talk publicly about it. Now, granted, just the history of it is like Dave Portnoy almost destroyed this for everybody, because he was using that kind of workaround to talk publicly via his channels about the ETF he was working on. And then, if I remember correctly, one of the Pompliano brothers has like a sports ETF, which is like stocks that anybody could buy of sports teams, but they package it up into ETF, and then he uses his megaphone to actually blast it out there. So I would guess that Meet Kevin has very little to do with the ops side of the business, and this is just a marketing play. And then to be fair, before you get in there though, I'm curious your take on this though. Is like, everybody that has any sort of platform, whether it's YouTube, et cetera, or an influencer, they usually end up like having something at the bottom of the funnel, like selling merch or et cetera. How is this any different from like a merch play or anything else like that?
Okay, so let's start with the index provider stuff you mentioned, because that is true. MSCI, for example, one of the brilliant things that has happened over the last decade or two that ETF sponsors realize, the question asked is like, why does BlackRock need MSCI? Why would BlackRock have all these ETFs that track MSCI indices? Or why does old Power Shares or Invesco track S&P? Like, why don't State Street, why do they track S&P? Why not just they're big shops, have their own? And the answer is because there's value to having an outside index provider that is only providing an index. Because when you run a fund product, you are governed by both the SEC and FINRA. When you are just an index provider, you don't even necessarily have to register with the SEC, right? So this is the brilliant thing Research Affiliates did. Research Affiliates versus AQR, right? Very, I'm going to use quotes here, similar-ish firms and like trying to run equity factor stuff. But what Research Affiliates did is they said, we don't want to run the money. We want to just create indices, and we're going to have other people put them in products and manage them. And then what we're going to do is we're going to market the shit out of those indices. And by the way, because we're not marketing the product, we can show a back test. So you can look at our index, you can look at the back test, and it's up to you to put together that index is being tracked by an ETF over here, launched by another company. And that was the big, like, marketing loophole of the 2010s, which, by the way, was very weird because mutual funds could not do that, but ETFs could for some reason. This is actually something that like frustrated me to no end, but this is why so many ETFs were implicitly sold on back tests in the 2010s on this smart beta idea, because all the index providers could create all these back tests, show them willy-nilly, and then people knew which products to buy. And that was, and still is very much the game. I don't think Kevin is doing that, because Kevin is acting as a sub-advisor to this fund. And it is an actively managed fund. It is not an indexed fund, as far as I can tell in the prospectus that was filed with the SEC. So I don't believe that's the case. I believe he will be actively picking stocks. So then the question to your point is like, okay, from a business perspective, he's got 1.8 million followers on YouTube. How do you monetize that, right? You don't just get like free internet bucks that like rain on you, like other than his courses and advertising and all this sort of stuff. Like, why not go down this avenue? And the answer is going to be, at least for me, he's going to end up potentially having a significant amount of regulatory scrutiny, and he's going to have to be incredibly careful what he says on his channel about any individual stock that may or not be coming in or out of his portfolio. Like, his whole shtick is talking about stocks. His whole shtick is talking about what he's buying and selling. And unless he sticks to what he says exactly in the fund, right? He could be publicly misleading investors and inviting an SEC shitstorm. And so to me, it's a question of, like, you're going to have to pivot your content. Are you going to lose your audience in pivoting your content potentially in a way that doesn't make this endeavor justifiable because of the regulatory risk?
Yeah, or I guess the question is, the only other question I could think of is that this is a longer term play where he's getting tired of being a YouTuber and now he wants to transition that audience into running like a financial firm, and he will maybe pull back, and this will be a nice excuse of why he can't be a public voice anymore.
I mean, look, he is polarizing, as you said.
For good reason.
For good reason. If you watch some of his content, you'll probably see why. I can see why people find him appealing, and I also at times find myself really shaking my head in disgust. That said, I do give him a tremendous amount of credit from a work ethic perspective.
Yeah.
As people that create content, the amount of content he has created over the last year and a half is absurd. And I think you could see over time, like, he literally seemed to have a bit of a mental breakdown, right? And I think he had to take a break from creating content because he was creating too much content. It is a difficult lifestyle. I know we tend to, as a culture, sort of make fun of content creators. You got to keep feeding the beast. Like the YouTube algorithm, to stay on top, you just have to keep pumping out content in a way that is very tough for content creators. And I think, to your point, to create a more stable lifestyle, you know, perhaps he has to use this as more top of market funnel, and then try to pick up some money in the ETFs that's maybe more stable assets, more stable cash flow that he can pull back on the content.
Those daily vloggers like Casey Neistat and everything, you burn out and they quit. So yeah, maybe this is that transition. But like you said, both you and I consume quite a bit of content because we're trying to reverse engineer it. So it's like no shade. Like I remember like blown away by the hours of content he created, but also doing it all himself and pulling up charts. And you're just like, how does he do this? Like, does he have 8 octopus arms? Like, so like you're saying, there's no shade on his work ethic by any means of the imagination. So maybe I want to do some house cleaning or whatever at the end here, but I want everybody to reach out in the comments, tell Corey happy birthday. You know, it's going to be interesting to see who gets to be first, but I'm going to say Pneumatic Samuel doesn't count. He's too quick. He's going to be first. So it's whoever he's negated. So it's whoever's first after Pneumatic Samuel. We have to figure out some sort of prize in the future or something for that. Maybe, you know, I don't know. You get a maybe Corey's going to be on Cameo. Corey's going to be on Cameo. He's going to give you a shout out on Cameo. But also,
I was going to say, also let us know what you think of these. I keep saying to Jason, you know, like, we
speaking
need
of
merch.
Yeah,
we need merch. Well, you know, it's my idea to have merch. Jason has never thought of it. He just refuses. He says merch is a bad idea, and I just say merch is great. I love merch. We should all have more merch.
Well, I got my new pirate swag hat. Yours is sitting on your doorstep. Somebody's probably stolen it by now because, I mean, let's be honest, it's a collector's item. But they can follow you at C. Hofstein on Twitter. I'm at Jason Mutiny. Shout out and follow Tyler Rangione on Twitter. Tyler's trying to come after my crown of like the amount of content one can consume in a week on nights and weekends. But I definitely would give him a follow as I was you, because he does amazing bullet points of all the stuff he listens to and watches. And so you can, I mean, it's shocking how good he is at it.
His emoji game is on fire.
Yeah, it's unbelievable. He's coming after all kinds of crowns. I mean, he's coming after Jim Oshag, like on the I mean, competing emojis versus GIFs. I mean, he's coming after all of us. I mean, I think he incepted us. I think we work for him now.
Well, I was going to say, he'll be replacing both of us soon enough. It'll be
exactly.
Tyler and Tyler.
Exactly. Thanks, everybody. We'll be back next Friday, 3 Eastern live. Look forward to seeing you all then.